Let's explore the array of mutual fund schemes offered by various mutual fund houses. These schemes can be categorized into two main criteria. The first is organizational structure and second is investment portfolio. Organizational structure classifies the mutual fund into three types: open-ended fund, close-ended and interval funds. Open-ended funds allows investment and redemption at any time. Close-ended funds have fixed maturity periods and interval funds permits investment during specific time intervals. Of course, we will discuss this in detail in next few slides. Based on the investment portfolio, means the type of investment the mutual fund has got. Mutual fund schemes fall into three primary categories. The first is equity fund, debt fund and hybrid funds. Apart from these, there are other interesting mutual fund schemes available in the market, such as exchange traded funds called as ETFs, equity linked saving schemes. These are the tax saving schemes called as ELSS, and gold funds which invest in gold. This unique offering will be briefly explored in this lecture. The open-ended fund schemes allow investor to buy and sell units at any time, offering flexibility. Open-ended funds continuously accept new investment and provide the option to exit wherever or whenever an investor desires. Closed-ended funds have fixed maturity period. Investor can only invest during the new fund offer NFO period. After that, units can be bought or sold on stock exchange, but the fund is liquidated at predetermined date. So you cannot invest in closed-ended fund at any point of time. Of course, you can buy or sell it, but you have to do it in the stock market where the liquidity of such funds is very less. The next is called as interval funds. Interval funds combine features of open and closed funds. They accept investment at specific intervals such as monthly, quarterly or annually, while allowing redemption only during predefined intervals. So you cannot buy it or redeem it whenever you want. So most of the investors prefers open-ended funds primarily as they allow investment at any point of time. So being a new investor, I would suggest you to go for open-ended funds. As you become a seasoned investor, you can go for closed-ended funds or interval type of funds. The next is equity, debt and hybrid funds. Equity funds primarily invest in stock or equities of companies. They offer the potential for higher returns but comes with higher level of risk due to market fluctuations. Debt funds invest in fixed maturity securities like government and corporate bonds. These funds aim to provide regular income and they are generally lower in risk compared to equity funds. Hybrid funds are also known as balanced funds. Hybrid schemes invest in mix of equities and debt securities. The goal is to balance potential return and risk by diversifying across different asset classes. So equity got more risk and debt got less risk, but return through equity are more, debt are less. So if you make a balance of equity and debt, you can get better return with minimizing the risk. Equity mutual fund dominate the landscape of mutual fund investments in India, constituting the largest portion of total investment. Equity funds are then further categorized into distinct types such as catering to different investment strategies and risk profiles. The categories of equity funds include large cap funds, predominantly invest in established and well established companies with large market capitalization, like the mutual fund scheme that invest into large cap stocks like ITC, Hindustan Lever, TCS, Infosys, Reliance, SBI. These funds are known as large cap funds. They aim for stability and growth, often offering more conservative returns because these are already grown organizations. So the potential growth for them is at very lower rate, but they offer stability. So you cannot imagine that SBI or falling of SBI or bankruptcy of Reliance. Mid-cap funds invest in companies with medium-sized market capitalizations. These funds offer a balance between growth potential and risk, catering to investors seeking moderate level of risk. So if you want to take some risk, you can go for mid-cap funds. Small cap funds target investment in companies with smaller market capitalizations. They offer higher growth potential but come with higher volatility and risk levels. The next category is multi-cap funds. These funds have flexibility to invest across companies of all sizes, including large, mid, and small caps. This diverse approach allows fund managers to adapt to changing market conditions. So, if large cap are not doing well, mid cap and small cap will do well. If mid cap are not doing well, small cap will do well, and you can increase value of your investment. Sectoral funds focus on specific sectors or industries such as technology, healthcare, or banking. They offer targeted exposure to a particular sector performance. Each category within equity fund serves different investor preference and risk appetites. The key is to align your investment goals and risk tolerance with appropriate category to achieve the desired financial outcome. This slide compares the large cap, mid cap, and small cap fund based on their potential returns and risk level. Liquidity also considered. Large cap funds offer moderate returns with lower risk and higher liquidity. Mid cap funds offer better results than large cap funds but comes with higher risk. Small cap funds can provide the highest returns but also carry the highest risk. Holding small cap investment for longer term can potentially mitigate some risk and yield better returns. So if you want to buy small cap fund, you have to hold it for at least for 7 to 10 years. Then you can get better returns with minimum risk. The next two slides shows the examples of how much money you could make from different type of funds in India. These include large cap, mid cap, and small cap funds. Even though how well these funds did in the past doesn't always predict how they will do in future. Of course, people still like to compare based on what happened before. So past performance is mentioned. In one of these slides, they are showing how these funds did over the past 5 years. The ones we are talking about are the best ones, and the average of all funds in the category will likely to bit a lower around 5% less. So we are talking about the best. If you take average category, you can assume its performance is 5% less than the top performing funds. For example, large cap funds have given 20% returns consistently over last 5 years, while mid cap funds did around 30%. Now let's talk about small cap funds and sectoral funds. Small cap funds have done really well with almost 40% returns per year over last 5 years. This means that your money could have been doubled in less than 2 years. They also talk about another fund that invests mainly in pharmaceutical companies. This fund has given a return around 22%. These kind of funds can be a good choice when the government rules or country's financial situation help a specific industry to grow. So if government is giving tax relaxation to the tech companies, then tech companies will do well. So this is about equity funds. The next category is debt fund. So debt fund is the type of mutual fund that puts money into fixed income instrument like corporate and government bonds, corporate debt securities and money market instruments. These instruments aim to provide capital appreciation over time. Debt funds are also known as income or bond funds. Debt funds are preferred by the investor who want low risk options, or those who invest in traditional assets like fixed deposits and bonds. People looking for short term places to park their funds, or the senior citizens seeking payout at regular intervals. The debt funds are preferred by this kind of investors. So the different kind of debt funds are liquid funds. Liquid funds invest in very short term period. They have a maturity up to 91 days. They are highly liquid and suitable for parking surplus fund with a short term period while generating modest returns. So if you have money that you don't want to use for next let's say 4 months, 5 months, so you can invest it into liquid fund. Liquid fund will give you the returns around like 9%, 10%, not even 10%, 8% to 9%. So you can get the return better than the bank FD. So liquid funds primarily invest in the market securities which has a maturity of around 91 days. The next is ultra short term fund. This fund invests in debt securities with slightly longer maturities, typically between 3 to 6 months. Fixed maturity plan funds have fixed maturity date and invest in debt instruments that match that timeline, providing investor with predetermined investment horizon. The next is gilt fund. Gilt fund primarily invest in government securities. These bonds are considered relatively safe but might have a lower returns compared to other debt funds. The next is dynamic bond fund. Dynamic bond fund adjusts their portfolio maturity and allocation based on changing interest rate scenarios to maximize returns. The next is short term funds, investing in debt instruments with maturities around 1 to 3 years. This fund aim to provide better returns than liquid or ultra short term funds with slightly more risk. So for a novice investor like you, I would recommend to invest in equity fund primarily, and you can 10% to 15% of your investment you can put into debt funds like dynamic bond fund or gilt funds. Exposure to debt fund should increase with increasing age. The next category is called as hybrid funds. These are very popular among investors. Hybrid funds are also known as balance fund. This investment scheme is a blend of both equity and debt instruments within a single portfolio. So hybrid, the word itself suggests you the hybrid funds invest in debt and equity. This combination allows investor to potentially benefit from the growth potential of stocks while also enjoying the stability of bonds. So bond has better stability than stock. Bonds prices doesn't fluctuate like stock prices. Each hybrid fund is designed with a specific mix of equity and debt, catering to different kinds of investors and their risk appetites. The allocation of equity and debt can vary widely based on funds objectives and prevailing market condition. So if the market is growing well, the allocation will be 50-50% or maybe 70-30%, 70% equity, 30% debt. If the market is not doing well, then this allocation might change like 70% debt, 30% equity. So hybrid fund has got that flexibility. So hybrid funds returns are more stable than the equity funds. Now advantages of investing in balance funds are diversification. By investing in balance fund, you are buying a mix asset classes, Hybrid funds offer diversification which can help to mitigate the impact of poor performing segment on the overall portfolio. The next is lower risk. The presence of debt instrument in the portfolio provides cushion against the volatility that is the inherent quality of stock market, which makes hybrid fund generally less risky as compared to pure equity funds. The hybrid funds can be categorized as balanced fund, equity oriented and debt oriented. So in the next slide we will see the details. Equity oriented hybrid funds, these funds have higher allocation to equities, typically around 65 to 80%, with the remaining investment in the debt instrument. They are suitable for investors seeking higher growth potential with some level of risk. Okay. Now the next is debt oriented. These funds, a larger portion of these funds, often 70 to 80%, is invested in debt instruments, while a smaller part goes into equities. They are favored by conservative investors looking for stable returns with limited exposure to equity market fluctuations. So when you are 70 to 80 age and you want your investment to be safe and you want some kind of appreciation, then debt oriented hybrid schemes are preferred. The next is balanced funds. They are also known as aggressive hybrid funds. They maintain a balanced allocation between equity and debt, typically around 60 to 65% equity and 40 to 45% in debt. They aim to offer a middle ground between growth and stability. So depending upon your age, risk appetite, you can either choose equity oriented debt fund, debt oriented hybrid fund and balanced fund. Now next we will consider the cost of investment in mutual fund, as you are giving your money to someone for investing, some professional for investing in the stock market. He will charge fees. Every fund levies fees from investor for managing their assets, which is essentially the cost for investing. This fee is known as expense ratio. So let's discuss the same. The expense ratio is a crucial metric that investor in mutual fund should consider while buying a particular mutual fund scheme. It represents the total annual cost associated with managing and operating a mutual fund as a percentage of fund's average NAV, that is net asset value. In other words, it indicates the proportion of funds asset that are used to cover various expenses related to its administration and management. Fund has to do the payouts for towards the managing the funds, means salary to the employees, marketing cost, administration cost. So this cost is taken from the investment, your investment. So, and that is called as expense ratio. The expense ratio is calculated annually and expressed as a percentage of funds average net asset value over a specific period. The NAV is the value of funds asset minus its liabilities divided by the number of outstanding units that we have seen. Now how the expense ratio is calculated, let's see. Expense ratio is equal to total fund expenses upon average net asset value into 100. So let's understand what is the impact of investor returns. A higher expense ratio means larger portion of investor returns is being used to cover the cost of running the mutual fund. As a result, higher expense ratio can eat into overall returns generated by the mutual funds. Therefore, investors generally prefer funds with lower expense ratio. When comparing different type of mutual fund, it is important to consider expense ratio alongside other factors such as historical performance, investment strategy, and risk profile. While low expense ratio is generally preferred, investors should also evaluate whether funds management and strategies justify that cost. So, in summary, the expense ratio provides investor with a clear understanding of cost associated with investing in a mutual fund. So it's a crucial factor to consider when selecting a fund. It is directly impacts investors' potential returns. So you should always go for the fund with lower expense ratio. But again, that fund has to perform well. So you need not go into the calculation details, etc., etc. So just remember, you don't have to calculate that. Fund takes care of it. So you just remember while investing that you should, if you are buying, if you have two options, buy a fund with lower expense ratio, because that will give you the better return, because expense ratio is the money that is taken by mutual fund house from the investment made by the investors. So this slide shows the example of expense ratio is used to calculate NAV. The next is entry load and exit load. The entry load is a fee or charge imposed by an investor when they are invest in mutual fund scheme. It is deducted from the amount the investor initially puts into the mutual fund. Nowadays, most mutual funds do not charge any entry load. An exit load is a fee that an investor has to pay when they decide to redeem or sell their units in a mutual fund scheme. This fee is deducted from the redemption proceeds before the investor receives their money. So if exit load is 1%, so whatever you are getting after your redemption, 1% is deducted from that, and the remaining 99% is given to you. The purpose of an exit load is to discourage investors from withdrawing their investment too soon after entering the scheme. Now, exit load amounts and their duration often depends on the factor like type of mutual fund scheme and the length of time an investor holds their investment. For example, equity funds might have shorter exit load periods compared to debt funds. Exit loads might be higher for short-term investment with the intention of encouraging investors to stay invested for the longer time. The exit load gradually decreases or becomes zero. For instance, exit load might be applicable if investor exits within a period of 6 months, but if they hold their investment for more than a year, there might not be no exit load. Exit load for debt scheme is generally zero. For equity schemes, charge the exit load if you redeem your investment within a year from the date of investment. So if you redeem your investment after 1 year, there won't be any exit load. So these exit load are so small that you can ignore them. Now, options in mutual fund. When you are thinking about investing in mutual fund, there are two main choices that you will come across. Option 1 is called as growth option. That means that any profits or gains made by the mutual fund are reinvested back into the fund itself. So over time, the value of your investment can potentially grow. The second option is a bit different. This is called as IDCW. This stands for income distribution cum capital withdrawal. You might have heard it referred as dividend option in the past. With this option, income generated by the mutual fund is distributed to the investor at regular interval. It's like getting a little piece of the earning from fund periodically. So for example, let's see, HDFC top 100 fund offers two choices. one is growth option, another is IDCW. Now here is something interesting. If you compare the net asset value of growth option and IDCW option, you will often notice that NAV of growth option is higher, because in the IDCW option, some of the earnings are given out to the investor regularly. So as some of the earnings are given to the investor regularly, the value of total investment falls. So NAV falls, because NAV is the value upon total number of units. So total number of units remain the same, number of investors remains same, but the value decreases because the sum of the portion of the investment is given back to the investor periodically. So let's compare these two options. IDCW stands for income distribution cum capital withdrawal. It's a specific option that investor can choose when investing in mutual fund. This option allows a portion of investors' capital to be paid out as dividends. With IDCW, a part of earning generated by mutual fund is distributed as dividends to the investors. This means that you receive share of profits made by the fund. The net asset value of mutual fund is affected by the dividends. When dividends are paid out, NAV decreases in the proportion to the amount distributed. Growth option in mutual fund is a choice where investors don't receive any regular payouts or dividends. Instead, the money you invest in growth option remains within the fund and continues to grow over time. The magic of growth option lies in compounding. The earning generated by mutual funds are reinvested back into the fund itself. This means that your initial investment not only earns return but also earn returns on those returns. Means whatever returns are again reinvested in the fund, so you are earning return on your principal and earning return on the interest, means the return that you have achieved from the mutual fund. So over time, this compounding effect can grow significantly, increase the value of your investment. So the difference between IDCW and growth options is given on the slide. Now what to choose? Choosing between growth and IDCW plans. The decision between these two options depends on individual's investor financial goals, risk tolerance and investment horizon. So these three factors are considered or should be considered while choosing between growth and IDCW. For you, I would suggest to go for growth plan. Don't even consider IDCW plans, because you don't need the regular payouts from your investment till age of 60. So investor who prioritize long-term wealth accumulation without requiring regular income find the growth option more suitable due to the compounding effect. For example, goals like building retirement funds, buying house or child education, growth option is very suitable. Investor who need steady income to cover their living expenses or other financial obligations might prefer IDCW plan for its regular payouts. This type of plans are suitable for senior citizens or investor who seek or who want regular payout or who prioritize regular payout than wealth building. So this option can be also considered for goals like going vacation every year. So you invest some amount, you opt for IDCW. So every year you will get some portion from your investment and you can enjoy your short-term goals like going on vacation through this investment.